Good afternoon, folks. This is Kevin McNulty. I lead Withum's R&D tax credit practice. Thank you so much for taking the time today to get some CPE credits and also learn a little bit about the R&D tax credit. There's some nice things going on lately with the tax credit. It survived tax reform, and there's some a few nuances taking place with the tax credit, which we'll update you on that hopefully you can take advantage of, in your business in terms of going after the R&D tax credit. I have been with Withum for a couple of years now. Prior to that, I spent a significant amount of time in the Big Four, approximately 15 years, basically with the R&D tax credit, based out of New York City. So I've seen a lot. It's some exciting things going on with R&D tax credits, and we hope you get some important items out of this next hour or so. From a high level, we just want to give you the technical knowledge necessary to identify the R&D tax credit, and of course provide a general overview and understanding of the credit itself. The agenda. We're pretty much going to run the gamut from a high level. Obviously, we only have about 45 minutes or so we're not going to get too deep into technical detail. We don't want to bore you with that, but overall, we should give you a nice feel for what the R&D tax credit is all about, and how you can hopefully use it and utilize it on a go-forward basis. I'd like to introduce my manager, Tyler Collins, who is with me as well, and together we will take you through the R&D overview.
Great. Thanks, Kevin. Hi, everyone. This is Tyler Collins. I'm a manager with Withum, just specializing with exclusively with the research and development tax credit. I've been doing this credit exclusively for the past 5 years, and it's a great benefit, so I'm happy to take you through it. So our first slide just kind of goes through the history and benefits of the R&D tax credit. And just to prelude, this credit was made possible through Congress implementation into the Internal Revenue Code, specifically Code Section 41, back in the early 1980s. And it was really a way just to incentivize companies for keeping their research and development efforts here in the United States rather than outsourcing it to foreign countries like India or Canada, which are great developers of software. So I also do want to highlight that this tax saving is a credit and not a deduction, so it truly is a dollar-for-dollar reduction of your taxable liability. And we'll go into it further down in the slides, but you can even be in taxable losses and still recognize an R&D tax credit benefit. So we think that's pretty cool, and we'll get into that further in a few slides. So again, the R&D tax credit really does help your bottom line on your tax return, and could significantly even swing your effective tax rate should you get a high enough credit. And it can be claimed for not only the current year snapshot in time. The R&D credit is looked at on an annual basis and is filed with your annual tax return. So it can be looked at for not only the current year, but for all open tax years, which is normally the prior 3 years as well. So if you're an R&D tech company and you've never been performing an R&D credit before, you could technically get a 4 years worth of credit should you choose to do so.
Yeah, and Tyler, those are great points. And basically, what's great about the R&D credit, it's now a permanent part of the tax code, which we'll talk about shortly. And with the tweaking of the law, so to speak, to bring back these small taxpayers, startups, as defined by the IRS, it's also a great component of the R&D tax credit. It is a credit as opposed to a deduction. There are 2 ways you're allowed to calculate it. You're allowed to choose the one that provides you the larger benefit. Open tax years. So there's so many aspects of it, as it also survived, tax reform, as I previously stated. So, it's an exciting time for the R&D tax credit, as exciting as you can get for tax credits. But, we'll take you through some of the important items as we go along here.
So there were some pretty significant changes to the R&D tax credit that had started starting in the 2016 tax year. And that one, legislation has now made the credit permanent. The credit, since the 1980s up until 2016, used to expire at the end of each tax year. So it made it difficult for taxpayers to plan out in the future and plan accordingly to see whether or not they would get a tax credit for the future. And now that it is permanent, it is a lot easier to plan for and to see that there will be cash flows in the future. So just to help your overall tax profile.
Yeah, and that's important when we're, both from a practitioner perspective, ours, the Withums and the Big Fours and so on of the world, laying out the game plan of the tax extenders, which, oftentimes held the R&D tax credit hostage until, December or actually into the next year oftentimes. So, it's hard to kind of, plan for getting the work done. And of course, from a taxpayer perspective, it's challenging to budget for that, whether, there's always the potential of the R&D credit not being there for them in the next year. So it's wonderful part of the tax code a few years ago, obviously job security too for practitioners like us, which is wonderful, but also the fact from the taxpayer perspective, you folks, it's out there. It's every year. You can attempt to go after it. So, we're very happy after so long that it has become a permanent part of the code.
Exactly. And even more so with the 2017 tax reform, most corporate deductions and credits did go away. The most significant of that being the 199 domestic production activities deduction. So it is great to see that the R&D tax credit has survived reform after reform, especially with the sweeping changes from 2017. And then additionally, another great 2016 benefit is the new opportunities for small businesses. So previous to 2016, most small businesses could never claim the R&D tax credit because they were in a taxable loss position. So now this new opportunity makes it so that any taxpayer, whether you're making income or not, or taxable income or not, can claim a credit. And we will be going into the nuances and intricacies of this new benefit in a few slides.
Yeah, I mean, this was a great addition recently. As the R&D tax credit was part of the general business credits, a 20-year carry forward, 1-year carry back. So it's all about taxable income, right? So we talk to our, our clients and the taxpayers. It's if you didn't have that taxable income, but were performing qualified activity, it wasn't necessarily a priority. So what happens here recently with the, this small business tweak to the law is it brings a lot of taxpayers back to the table. Tyler and I sit out of New York City here, so there's dozens, hundreds of these small businesses cropping up, every week. So more often than not, they're there to make a viable business as opposed to bottom line taxable income, and in doing so, they perform qualified activity. So it's been quite exciting, and the phone's been pretty much ringing off the hook over the last year or so because of this opportunity that brings these small taxpayers back to the R&D table, and it can be quite lucrative, especially in the context of a small business as well. an R&D credit could help a small business keep their doors open for longer than they potentially would have otherwise. So, it's a great opportunity. It's expanding the R&D tax credit, so we're excited about it, and we're happy to assist.
And additionally, while not as new, considering this was introduced in 2015, but the IRS did clarify to taxpayers regulations surrounding the internal use software. We'll get into it in future slides, but there is a 4-part test that we need to meet in order for an activity to qualify for the R&D credit. And that 4-part test becomes a 7-part test if we're dealing with internal use software. So prior to the IRS releasing the regulations in 2015, clarifying those internal use software rules, there was a lot of contention because it wasn't clear what was and what was not internal use software. So with the 2015 regulations, it truly was a taxpayer favorable event in that the IRS strictly states that an R&D activity that is internal use software is one that is mainly benefiting a taxpayer's internal processes. More so specifically, to give an example, a software that would help your administrative or human resources functions. Prior to 2015, the IRS deemed anything that wasn't client-facing or customer-facing to be internal use software. So you could be developing back-end software development, and the IRS would have claimed that was internal use software and thus put it through those additional 3 hurdles, those 3 additional tests to determine whether or not that software would qualify or not. So it was a great taxpayer feat in 2015 when the IRS finally clarified what is and what is not internal use software.
Yeah, that's right, Tyler. I mean, after so long of not having final rules or regulations around software, especially with the advent of technology, it was always so challenging, even as far as an audit with, convincing, taxing authorities that software was, R&D qualifiable, creditable, and so forth, because these internal use rules or the 3 additional tests were out there, which oftentimes kind of got hung up in audits and reviews. So it's great that they become so more defined and mostly taxpayer favorable, because from a practitioner perspective, it was always challenging. If you weren't the Microsofts of the world with the software that's easily recognizable, saleable, oftentimes you would be challenged. So it's wonderful that after so long we have some final rules on these software internal use regs.
All right, so now let's get into what is and what is not an R&D qualifying activity. So per the Internal Revenue Code, R&D activities performed by a taxpayer must meet what we call a 4-part test for their associated expenditures in order to qualify for the R&D credit. And you'll notice when we go through each of these 4 parts that they are fairly general and broad in nature, in that they were designed to apply to nearly every industry in the United States, be it software, retail, pharmaceutical, you name it. This 4-part test is the same test applied to every industry performing R&D activities. So the first test is that what a taxpayer is doing in a given tax year must be technological in nature. So what the Internal Revenue Code defines this as is that the taxpayer is dealing with a hard science, which is engineering, computer science, a physical science, or biological science. So we just like to get to the true heart of what the R&D credit is, in that it is a technical-driven credit. So we do aim to eliminate those soft sciences such as economics, psychology, right? Really just any of the social sciences, and just truly focus in on what is technological in nature. The second test is related to functional development, and we also like to call it permitted purpose. So the taxpayer in a given year must be creating a new or improved product or process. We also like to call it a business component, which is what it is you're developing over the course of the tax year. And when it comes to improving a previous iteration of a product or process, it can be related to its functionality, performance, reliability, or quality. So just to summarize, what is it you're building, and is it new or improved? The third test is technical uncertainty. So at the outset or during the development process, what were the uncertainties, the challenges, the issues that you faced in developing your business component? So there always has to be that question of what do we do next, that fork in the road of where you would need to choose between one or more alternatives to get to your end result. And in trying to uncover that technical uncertainty, you need to employ what we call a process of experimentation. And it's that process of experimentation that seeks to provide the answer to that uncertainty. And it does really bridge the quantitative and the qualitative together for the R&D tax credit. And a great example of what qualifies as process of experimentation is just a simple systematic trial and error, where you just constantly go through an iterative experimentation process to kind of rule out what does and what does not work.
Yeah, Tyler, a good point about this is the fact that the four tests themselves pretty much span all industries. So, it is vague the way it plays out, because you have to apply these four tests to all industries. But it's quite interesting. The first two tests are somewhat fairly easily recognizable from a taxpayer when you're looking to see if there's a potential benefit there. So, in how we've been dealing with clients and potential clients lately, we've realized that the first two tests are either a go or a no-go. So then, it appears that the bulk of the investigation does focus around the third and fourth test. Basically, the third test are your headaches. From a technical perspective, what were the headaches encountered? And then the fourth test is the answer or the attempted answer to those headaches, in keeping it in the most basic layman's terms. So that's a good way of going about our business and identifying R&D credits. The fourth test is a great one too, because generally speaking, the first three are static in nature, whereas the fourth one is where you can begin to quantify the resources associated with the R&D tax credit, which of course is very important, because you got to figure out how big of a credit you may have to chase down. And we'll go into that shortly in terms of how this segues quite nicely into the expenditures associated with the R&D tax credits. But right now, we just want to finish up. Actually, I think we're going to do our first polling question. And then right after that, we'll just circle back to the additional three tests briefly, because we touched upon them already.
Here's our first polling question. We'll give you guys a couple of seconds here to answer this. About 10 more seconds. All right. Thank you.
Thanks, folks. We'll move on now to the additional tests, and then we'll get into some costing aspects of the R&D credit.
All right, and as we discussed before, there are those 3 additional tests that taxpayers need to meet should it be deemed that they're creating what we call internal use software. And just based on my experience, having done probably over 100 R&D studies this past year, we don't see this very frequently at all. We may have touched upon one internal use project of probably hundreds, if not 1,000, that Kevin and I have touched, but we do just want to put it out there that there are 3 additional tests that must be met if you are, in fact, creating software invoking research and development for internal purposes, that is, for your administrative functions or your human resource functions. And those 3 additional tests are that it needs to be innovative, have significant economic risk, so should it fail, that you did in fact put a lot of employee or contractor research resources into it, and that it is not commercially available, meaning it could just be purchased from, let's say, Best Buy, installed, customized a little bit, and you want to claim an R&D credit on it. We can't do that. So now that we've gone into what activities do and do not qualify for the R&D credit, let's discuss the associated R&D expenditures that roll up into the overall R&D credit. So there are 4 buckets of expenses that the IRS has stipulated, and those are, I'll just go through them briefly and then we'll go into them more in depth. Employee wages, supplies, third-party contractors, and rental or lease costs of computers. So starting with wages, these are your Box 1 W-2 annual wage amounts paid to employees performing research and development for your company. And again, this is employee time spent on qualifying activities. So we do need to look at the projects that they had worked on during the year and determine whether each of those projects qualify or not. And then we can take a percentage of an employee's time and then multiply that by their Box 1 W-2 amount, and that gives you what we call a qualified research expenditure, QRE. And it's these QREs that end up flowing through the R&D calculations and then feeding into the overall credit amount. So that's wages. The second bucket of R&D expenses that qualify are materials used and or consumed in the R&D process. So if you're a pharmaceutical company performing clinical trials, you can expend or claim for the R&D credit all expenditures related to the clinical trial. Third on the list is third-party contractors. So if you outsource within the United States your testing or outside expertise where you need just an outside consult, we can claim 65% of outside contractor assistance to the taxpayer. And then lastly, this is the rental or lease cost of computers. So if you are developing software and you use the cloud in assistance with your development, such as Amazon Web Services, so long as you are not the primary operator or administrator of these outside servers, we can claim the invoice expenses associated with these rental or lease costs of computers for your software development.
Yeah, and recently, folks, we've been seeing quite a bit of that as this category of R&D expenses does increase. But it does make sense. Most folks, or many of taxpayers, moving to the cloud. But it's interesting, just to kind of put in proper perspective. So the four-part test are the rules themselves. And once a taxpayer is comfortable with their resources associated with those four-part tests, here are the dollar amounts that could generate the R&D credit. And from a software perspective, and we'll talk about that a little bit later, how many industries really rely upon the software R&D. The vast majority of the expenditures will be people time, so to speak, quote unquote. And that would be the first and third categories. It's going to be the W-2ers, so to speak, and the 1099ers. Those are the vast majority of what we see on our taxpayers in terms of R&D claims. So it's all about understanding the four-part test, associating it with their resources, and then tying it back to the people time, and of course the rental or lease of computers.
And this next slide just kind of gives a visual of how we quantify the R&D credit again. So this is more of a visual presentation of the previous slide. So in the upper left-hand corner, we always like to ask for work charts. And what this really does is it helps uncover employees who we may not have otherwise thought would qualify for the R&D credit. Sometimes we could even take marketing folks if they are acting as a bridge between the developers and the end users, and they are assisting in the R&D process. So it is important to look at a work chart of your entire organization so we could really try and just look under every rock for R&D opportunities. And again, in the lower left-hand corner, those are, the four buckets of qualified costs that go into the R&D credit. And on the right-hand side is that time allocation. So we do like to apply percentages of time to either individuals, employee by employee, or to groups of job titles. So if everyone, in your QA department is performing 20% R&D, then all of the individuals in QA are 20% qualified, and then we take 20% of their Box 1 W-2 amount, and that gives you the wage qualified research expenditure amount.
Yeah, from a practitioner perspective, this is a great visual presentation in that it kind of brings it all together. At the end of the day, what exactly are we after in terms of generating an R&D credit for a taxpayer? So it's usually the worker bees, so to speak, the development team, and then maybe one level up and one level down, direct support or direct supervision. And then on the right-hand side there is pretty much what we go through to figure out the resources, the people time again, W-2ers and 1099ers, who may have performed some qualified activity, and that begins to generate the R&D credit. And we'll give a couple examples towards the end of the presentation to kind of bring the whole visualization to a finished product.
And with that, we have another polling question.
And folks, on the first polling question, sorry we did not say it, the answer was the four-part test. So a little bit of a softball there, especially since the seven-part test was not available. So it wasn't a trick question. So here's your second polling question.
A few more seconds here. All right, we're going to close the poll, and here are the results.
All right, people are paying attention.
All of the above was the answer there.
All right, so now we're going to go into a little bit more of an intricate matter of the R&D credit, and that is funded research. So high level, when there's research and development being performed, we like to ask ourselves, whose credit is it? Whose R&D credit, or which taxpayer deserves this R&D credit? So if you are have contracts with your contract researchers or your customers, we need to determine whether or not, through contract analysis, whether the R&D is funded or not. And there's two general tests that need to be met to satisfy whether the taxpayer is can claim the R&D being performed or not. And that is whether they are bearing financial risk or whether they hold substantial rights to the research being performed. So in bearing financial risk, we really look for fixed fee contracts in which there's a contingency on whether or not the taxpayer gets paid for successful research or not. So in the case of government funding, if you're paid for your R&D, regardless of whether it's successful or not, and that payment is kind of guaranteed, you unfortunately are not eligible for the R&D credit because you do not bear what we call financial risk. It's the government that bears that financial risk, and the government can then claim the R&D credit. And then additionally, in looking at contract analysis, do you hold the substantial rights to that research? So just kind of using that previous example again, if a government agency hires you to build, let's say, software, and at the end of that software development, you have to give up the intellectual property to whoever was paying you, then you do not hold substantial rights to that research. The government does. So the government can claim the R&D credit because they bear the financial risk and they hold the IP to that software. Because sometimes taxpayers like to claim R&D whether it's really theirs or not, because there is that gray line, that confusion as to whether or not it's funded or not.
Yeah, good point, Tyler. This is a standalone slide, folks, but it's an important aspect of many investigative, taxpayer R&D claims. It's all about understanding who truly does have the rights to the development effort and who's at risk. Oftentimes you ask yourself, can the other side of the equation take the R&D credit? That's a good way of understanding whether or not, your R&D claims are funded. And that should not be included for R&D claims.
Right. And one of the most pivotal law cases surrounding this is Fairchild, and this was the standard-setting case for funded research. And it basically, at the conclusion of this case, they tried to just uncover the answer to whether or not you are at risk, turn to which party bears the research costs upon failure of the project. So when retention of payments to you is contingent on performance, such as the successful design and or development of new product or process, you bear the risk of failure. And again, on this slide, we give indicators of both qualified activities and non-qualified activities. So on the first box above, these are examples of activities that would pass the 4-part test that we had gone through before. I'm not going to go through each of them specifically, but when you read these 5 to 10 bullets, these are examples of activities we do like to see taxpayers performing in a given tax year, as it does truly indicate that they are in fact performing research and development type activities. But more importantly, and we didn't touch upon this in the prior slides, are examples of non-qualified activities. And I will go through each of these bullets individually because it is important to understand what is in fact non-qualifying. And the first of which is research conducted outside of the United States. So this is a United States-based R&D tax credit. So we cannot be claiming R&D expenditures from abroad. The R&D activities must be performed on U.S. soil in order for it to be eligible for and to be claimed for the R&D credit. Additionally, reverse engineering. So if you're a pharmaceutical company and you take a brand name drug that may have just gone off its patent and try and reverse engineer it to create a generic formula, that is not research and development, because the taxpayer who created the original formula is the one entitled to that R&D. Additionally, adaptation of an existing product to a particular customer's requirement or need. In other words, taking a software and customizing it to a particular customer's needs. That is not necessarily R&D, because most of the R&D was expended in creating that standard product that then needed to be customized slightly for a customer. Routine data collection and market research. We see this a lot, that our taxpayers like to claim business risk or marketing risk and trying to uncover that. Sometimes clients feel as though that is R&D when it is in fact not, because it doesn't pass that first part of the 4-part test, and that it needs to be technological in nature. And then lastly, anything really related to cosmetics. So changing a web page from blue to red does not constitute research and development.
And next up is the qualified small business. We referred to it earlier. As we said, this brought a lot of taxpayers back to the R&D table. So it's quite a lucrative undertaking if warranted. So, very interesting tweak to the law about 1.5 years ago. So Tyler will take us through this now to understand a little bit more about the nuances about whether or not you could be a qualified small business.
Great, thanks, Kevin. Yeah, so with the 2016 new tax legislation, if you are deemed a qualified small business, you can claim a tax credit, an R&D tax credit against your payroll, your quarterly payroll amount. So there are 2 tests in which that need to be met in order to be considered a qualified small business. So the first test is the gross receipts test. You can't have had gross receipts prior to the 5th previous tax year. So if you're claiming an R&D tax credit for the 2017 tax year for what we think may be a qualified small business, they can't have had any gross receipts prior to 2013. So that's what we mean by the 5-year test. And then additionally, there's another gross receipts test that we need to meet, in that you cannot have exceeded $5 million or greater in gross receipts for the tax year in which you're looking to claim a credit for. So if we meet these 2 tests, in that you don't have gross receipts prior to the 5th previous year and your gross receipts don't exceed $5 million, then you are a qualified small business. And then you are then able to take and benefit from the R&D tax credit. And there's just a couple of nuances with this, in that the benefit cannot exceed $250,000. Anything that goes beyond $250,000 just kind of gets lumped into your general business credit, and then you could take it when you do become taxable. And you do take the R&D credit against your payroll taxes in the quarter subsequent to your annual tax return filing. And you continue to use it quarter by quarter until it is fully exhausted. And what we do take against with the payroll taxes is the employer portion of the FICA, the 6.2% of wages tax amount.
And basically, folks, What's great about this credit is the monetization of it. Once again, R&D is traditionally part of the general business credits where you need taxable income to use credits, but that is not required for the small business credit. And they can monetize it in the following quarter. So basically, when you file for the R&D credit, should you have one, it's all based on the same tests. You can then monetize it in the next quarter against your payroll tax liability. Basically, that's 6.2%. And it could be, a taxable payable reduction for several quarters up until the R&D credit is fully extinguished. And I think we have our next polling question, number 3.
Here we go, launching this question. Which of the following is considered a non-qualified R&D activity? I'll give you guys a few seconds here. A few more seconds. All right, we will close the poll now. And here are the results.
All right, and the answer was, in fact, research conducted in Ireland. So good job. We will continue on to the next slide. So again, we had alluded to this before, but here's just a sweeping list of some of the many industries for which can take an R&D tax credit. It's obviously not an all-exclusive list, but it just goes to show anybody can claim an R&D credit if the activities they perform in a given tax year meet the 4 parts of the 4-part test. And additionally, a lot of the tax credit claims we see involve software, the developing of new or improved software. So here's just an example of some of the software developments that we like to see that indicate that there is R&D activities going on.
And it's interesting, folks, in that, oftentimes, a taxpayer and what their true business model is may not relate explicitly to the R&D credit, meaning you'll notice the prior slide, 10 or so industries, but half of them probably would have R&D claims around their software development. Being here, sitting out of New York City, investment banks, insurance companies, the little tech startups, it's all about software R&D claims. It may not be their true business offering, but yet their R&D claim will, revolve around the software development. So it's quite interesting. And that's why we do focus quite a bit on the software in this slide deck.
And then here's just another slide helping to identify further R&D opportunities. The 10K, that annual report, is very telling as to whether a company is performing R&D or not. More likely than not, there will be specific research and development expense line items that you could see in the 10K, which would indicate that that company is more likely than not performing R&D activities. We also look for acquisitions, dispositions. If a company acquires an R&D subsidiary, then they can start claiming that R&D credit. On the tax return side, we like to see there's like a business code, whether the company was technical in nature, and right on the first page of the 1120, are there wages? If so, that's a great indication also that there may be some expenses we can uncover there for the R&D credit.
And basically, folks, no taxpayer is ready for an R&D study. So these are actually the things we look to as well when we're vetting out potential opportunities at clients. It's all about investigation. It's all about, the resources working on technical development, because it is a technical credit. So these are the items we look to when we start to understand whether or not a taxpayer should pursue an R&D credit.
And there are two methods to calculate the research and development tax credit. There's the regular method, which is on the current slide, and then we're going to go into the alternate simplified calculation, which is on the slide after this one. So what we have here is just a visualization of the calculation. So should we discover that 7.5 full-time equivalents, each making $100,000, qualify, meaning that their activities for, let's say, 2017 were determined to qualify for the R&D credit, we would then determine that $750,000 of their Box 1 W-2 amount is a qualified research expenditure, and then it goes on the calculation. And then let's say this company had $25,000 of rental or lease cost of computers, and then we determine that $50,000 of contract research expenses qualify. That then gives us a total of $825,000 of qualified research expenses. If we flow this through the calculation, and assuming that this is a startup, that's going to be claiming the payroll credit as a qualified small business, a company with this fact pattern would claim an $82,500 R&D tax credit. Not yet. And then this is the same fact pattern flowing through the alternate simplified calculation model, which looks to the prior 3 years to form a base in which the current year must exceed. So you'll see this calculation results in an $80,500 credit benefit. So if we go back to the regular credit, this results in the higher benefit. This is the one you would take on your tax return.
Yeah, and it's interesting, folks, in that the government does allow you to run both calculations, as long as you have, the input to generate the R&D credit, and the one that generates a larger benefit for you is allowable. So we're constantly running both calculations, if applicable, for all potential taxpayers.
And with that, we have our next polling question.
All right. What is/are the acceptable calculation methods for quantifying the R&D tax credit? Give you guys a few seconds here. And the last 5 seconds for everybody who's on. All right. Closing the poll, and here are the results.
Good job. Most people answered both A and B, and that is correct. It's the alternative simplified calculation and the regular credit method. Those are the two acceptable calculation methods for the R&D tax credit. And when all is said and done and we calculate the R&D credit, we do look to substantiate and support that R&D credit. And we do that through project narratives, documentation matrices, and collecting supporting documentation. This is probably the more significant phase of the R&D tax credit study, because it is important to fully support the credit claim you're making on your tax return. And here's just a few examples of what we do look to collect as far as documentation for the projects you had done in a given tax year.
Yeah, basically, folks, R&D claims, or I guess submissions is better, are really two-pronged. It's quantitative, understanding those resources, the four folks, wages, supplies, contractors, and cloud computing. that kind of roll into R&D credit. Once we get a feel for the quantitative, the qualitative is the other prong. It's the storytelling, the support of that. And, you know, generally speaking, it needs to be proportionate to your R&D claim. You don't have to write, you know, a full novel for R&D claims, but, you know, it's a case-by-case basis, and understanding what your claim is and what your documentation needs to be is an important part of an overall R&D submission.
And then lastly, here's just a timeline of what an R&D study looks like. Here at Withum, we do provide a complimentary R&D consultation. We have a half-hour phone call with you, and we can determine pretty quickly whether you are or are not eligible for the R&D tax credit. At the conclusion of that call, we send a preliminary information request, and then we create a pretty precise estimate as to what type of R&D credit you may be looking at. And then once engaged, we go through the quantitative and qualitative analysis with you, where we quantify and support that R&D credit. We assist with the filing of that R&D credit and preparing for you a final deliverable report in the event a taxing authority ever questions your credit claim. And should they question it and you need audit defense, Withum is happy to provide that as well.
Thanks, Tyler. So that is the end of the presentation, folks. We do have some questions that have come in. So for the last few minutes, I can read them off and give my top of the head response here. First question, did you say 65% of third-party contractors? Yes, generally speaking, folks, for those 1099ers, as I said earlier, normally if they were performing qualified activity, so they are subject to the test, the 4-part test, and if so, we would take 65% of the invoice amount. That 35% reduction is pretty much just by statute, so it's the government saying you're not taking the full amount. So yes, as long as they're doing R&D, we can take it in full at 65%. Next question, would website and app and related feature development qualify as R&D for this credit? Generally speaking, yes, but it all comes back to the 4-part test, folks. So if we were at a point with a potential R&D'er, we would want to understand especially the 3rd and 4th test, the technical uncertainty faced during the website and app development, or the continued maintenance of it. You know, the software development life cycle has to be taken into account, but we want to make sure that there was some technical uncertainties faced and they were addressed via a process of experimentation, the 4th test. So from a very high level, yes, those would be some items we would look into further. Next question, if I'm understanding correctly. Capitalized web development salaries for qualified activities. Good question, if I'm understanding. The accounting mechanism for salary or how things are accounted for in the books and records don't necessarily play a high priority on R&D claims. At the end of the day, if we felt an individual, a web developer, and his or her salary claimed or was claimable for the R&D credit, we would end up taking a percentage, 0 to 100, of their W-2 box 1. So generally speaking, the accounting mechanism for that previous salary would not play into the claim for the R&D credit. So essentially, we could consider that a double dip to an extent. Next question. Are qualified supplies that were purchased from outside the U.S. but used in the experimental process that occurred inside the U.S. be eligible? Really good question, actually. High level, you know, facts and circumstance, the answer is yes. Excuse me. If there were some supplies purchased outside U.S. boundaries but used here on U.S. soil during the R&D development process, of which we claim the people time performing that, then yes, I would sense that the supplies used during that process would be includable for R&D claims. So that would be that second category of the 4 category supplies. Next question. If you are a startup company that has no revenue yet, but has R&D costs that qualify for the R&D tax credit, okay, assuming they meet the test, can those credits be applied in future years when you have taxable income? Really good question. So here's how I would kind of address that fact pattern. The new, the small business credit that Tyler took us into quite deeply in the slide deck is for the monetization for those taxpayers that don't yet have taxable income. So the quicker mechanism for getting those credits, so to speak, would be via the payroll tax credit. So if you're not yet taxable, obviously a lot of small businesses are focusing on the top line, not worried about bottom line yet. But if they're not taxable, it would probably make more sense to go after the payroll tax credit to monetize it each quarter or subsequent quarter as the rules read. But there is a mechanism within the form itself, Form 6765, whereby you can bifurcate where you want the credits to go, whether it be the payroll tax or the traditional route, which ultimately requires taxable income, obviously, to offset via credits. So that would be a true fact and circumstance, but there appears to be some flexibility. But generally speaking, to monetize it quicker would be to use the payroll tax, because once again, that would be in play or live, so to speak, after the next quarter after you file the tax returns. All right, so that's the, let me read one more. We got a couple seconds left. Oh boy, a couple more. Sorry, folks. We can actually, more than happy to do it via email after this, but I want to be cognizant of your lunch hour. If a customer pays for development R&D, but the company decides to go above and beyond what the customer requests because they think it will benefit the platform, can the company claim the credit? Interesting. Okay, so so in other words, someone is doing something on behalf of a customer. So this brings into play a couple of things. Funding. First of all, is this a specific development effort for a client or customer? Because that may be funding, which is not R&D for you, the taxpayer. It actually may be R&D for them. But it's a two-part question here. Great question. But if you go above and beyond what they asked, and once again, we'd ask about what did the people do, your W-2ers, your people. If they perform qualified activity, once again, focus on the third and fourth test, technical uncertainties and process of experimentation. If they did do that on behalf of the client, then absolutely, their percentages would be increased to include for that time. But the first step there would be the funding question, whether or not the taxpayer itself is entitled to this or if it's for the person requesting the effort. All right. There's a couple of questions left, folks. Allison, it is 1 o'clock. I do want to be cognizant.
We'll reach out via email to you guys. We have your contact info for those of you that submitted questions that we did not cover today. Thank you, everyone, for signing in and listening.